Hello, everyone. I'd like to welcome you to this forum. Thank you for taking the time to join us as we share with you our markets review for the last quarter and give an outlook for the coming quarter. So my name is Egla Kerubo. I am part of the marketing team. And without much to do, I will hand it over to Nike to.
Thank you, Egla. Ladies and gentlemen, once again, thank you once again for joining us in this memorable time with us. We do not take it for granted, but if you could allow us to give a slight introduction to SIB, for the new members especially, and if you've already joined SIB or know about SIB, kindly bear with us just for the introduction. Egla, if you could share, please. As we are getting the screens ready, we can see quite a number of participants. This is very encouraging. You can leave your comments, be very helpful for us. We really take your feedback seriously, and it's encouraging that give us positive and negative for us to be able to appreciate for all our investors. A slight introduction to SIB and who we are. So first of all, we are a company that has been there for 26 years. And our capital base is 850 million. Our values of what we manage in terms of assets could say they're 15 billion right now as we speak. We are members of the NSE, CDS, SIB, that is Kenya Association of Stockbrokers and Investment Banks. We manage a wide range of assets in terms of what we advise and what we manage, including governments, fund managers, corporations, financial institutions, and high net worth clients. Yes, so our journey. So as Standard Investment Bank, we started off as a stock brokerage firm in 1995. And then 2003, we got an investment banking license. In 2008, we were awarded the best investment bank. And this is not the only award. We've had numerous awards. It's just that we couldn't be able to list them in this presentation. 2016, we did a large transaction for Kengen. That was worth 28 billion of a rights issue. Then 2018, we received our license called a money manager license, which allows us to invest in unique products. And from there, we got our first fund, first global multi-asset strategy fund, hence called Mansa X. In 2019, we got a return of 24% for our clients. So just to speak about some of the services and products that we have. First, we have our equities, which from our stock brokerage side, that allows us to invest on stocks in the NSE and the derivatives market, which is the next derivatives market in the NSE. And we were actually the first institution to trade on it in 2019 to show our progression and our initiative. We also have a fixed income, which allows us to help clients invest, both local and foreign clients, to invest in in fixed income. We have recently introduced a new category called the Eurobonds desk. We are now able to trade on that. And I know one of my colleagues will be able to explain further on that. In our corporate finance department, which my other colleagues will explain, we are one of the largest in terms of advisory for both public and private institutions. We have a wide range of activities that we've done in the past, all the way from 2003 till to date. Our research department is quite rigorous and with a lot of due diligence, insights, and clarity into the investment opportunities that we have. We have our weekly updates, monthly reports, and both equities and also fixed income. We recently have our new department, which is exciting, which is our global markets department. And here is where our Mansa X product sits under, where we are able to trade not only local assets, which is equities, local equities, and fixed income. But we also are able to expose our clients to major currencies, precious metals, commodities, global stock indices, and selected single stocks from all over the world. We also, in this department, able to provide hedging solutions for our clients, both retail and both corporate. And now is to show you a picture of who we are. We are fantastic humans, as you can see from our photo. We are here in JKUAT Towers, 16th floor. Our team is actually expanding. We are increasing another floor. We also have other partners which are independent agents and financial advisors all over the country that we're able to get in touch with our investors all over. We can give an introduction to the board members. Yes, that's who we are in terms of our board members. Of course, our founder is Mr. James Wangunyu. We have a renowned director called Mr. Kihumba. There's Donald Wangunyu, Pauline, who's our head of finance, and yes, our only lady at the moment. We hopefully one day will bring in more ladies into the board. We really want that to happen. Nashon Mungai, our global markets head, and myself, Nike Wangunyu, who I'm head of strategy and operations, Zarik Musau is executive director for research, and George Akello, who's an independent director.
Good afternoon, everyone. My name is Lisa, and I'll be presenting on the equity markets, basically performance in the third quarter and our outlook for the fourth quarter. So we'll start with the macroeconomic overview. So generally, the economy contracted in 2020. I guess you're all aware based on the latest data from the National Bureau of Statistics. So the economy contracted 0.3%. There was a general slowdown in economic activity, of course, because of the pandemic. As you can see from the presentation, the decline was in the second quarter and the third quarter, but we recovered slightly in the fourth quarter. And we expect this recovery to go on, of course, in 2021. We've seen there's much more activity compared to the last year. Also in 2020, actually released in 2021, the GDP was rebased with a new base year in 2016, as opposed to the previous, which was 2009. So generally for 2021, we do expect that resumption to go on, and partly driven by infrastructure. As you can see, there's quite a number of roads going on and the ports. We've also had resumption of schools, which is partly driving the growth we expect in 2021, as well as other bits of the construction sector and a surge in global demand. On currency, the Kenya shilling weakened sharply from March 2020. Of course, that's because of the pandemic, as most of the economic activities locally and globally almost came to a stop. So it peaked at 111, but we've seen that strengthen again all the way from May 2020. It strengthened from December 2020 and then all the way to May, which we've seen again a bit of weakening. That is mainly because of global demand, as we've seen most countries globally resume economic activity, especially those who are in lockdown. And because of that sudden increase in global demand and a lot of trade resuming, a lot of currencies are under pressure. On inflation, we can see there's quite some uptick towards in the third quarter. That is mostly because of fuel. We've seen an increase in fuel prices. I'm sure you've all been tracking that to the extent that Parliament had to sit and debate the increase. So that is the main thing driving inflation. We also have food prices. We've been having a drought maybe the last quarter, which means that the short rains in the fourth quarter are very critical to inflation. Hopefully, we'll have a good performance in that. The last slide on private sector credit growth. We're done very well towards the end of 2020. But now in 2021, we saw that slow down slightly, mostly because a lot of capital is going towards fixed income, and we'll hear more about that from the next presenter. Okay, so still going on macroeconomics, of course, we need to look at the outlook. One of the things that are key for the next year and also the next quarter is the general elections. So previously we did a report called A Time to Sow, A Time to Reap. And what we discovered from that analysis is that there are some opportunities in the stock market actually during elections. It's not all negative. Generally, the market peaks during the election year, the NSE, which means the pre-election year is one of the best times to invest. So basically what we call sowing the seed, that's why we call attempt to sow, attempt to reap. And then as it peaks in the election year, you can hold for the gains or also lighten to get some of the gains of the capital appreciation. Post-election is a bit 50-50, and it's dependent on optimism on the new regime and the absence of any contestation of the elections. So generally we're saying, yes, this is your year to capitalize. Of course, current circumstances are different from previous data because we are coming right from a pandemic. So this year was a positive year also based on that. And in the end, of course, always look at your fundamentals. On COVID-19, which is something we can't ignore because that's what's a major effect on the economy. We expect the recovery to go on to 2022. As you can tell, we are also not at full-blown economic activity. We do think that as more people get vaccinated, some of the containment measures that are currently ongoing, such as the curfew, we expect that to ease. And of course, also globally, we are seeing travel restrictions easing a bit, so that will be positive to tourism. We might start seeing more tourism at least in the next year or even from as early as December. As you can see from that data, our vaccination rate compared to global, that is 15.6%, at least for the one dose, compared to 47.6%. We have quite a long way to go, but of course, as that picks up, then we expect the economy to pick up equally. One of the things we've seen from also resurgence in demand in the world as economies have opened up is there are few challenges with the supply chain, and that is also affecting our country, both on inflation and currency. So what's happening is because of very high demand and supply is unable to catch up at the same pace, and also freight costs. We're seeing shipping costs go up by almost over 100%. So of course that means with importation demanding more currency than usual for your normal goods, and also that will eventually affect inflation because that will be priced into the goods. So having looked at the economy, now we can narrow down to the market. So we look at the NSE, the equities market. In the third quarter, the NASI and NSE 20, NSE 25, at least you can see they both gained 2.8%, 5.4%, and 3.8% respectively. The performance in the third quarter was largely strongest in the first 2 months, July and August. It slowed slightly in September, which is also part of the reason you can see a slower growth compared to the second quarter. Also, a number of counters touched record highs, for instance, Safaricom and the banks. We had a rally, I think Safaricom got to 44.95, but come September, of course, the market corrected. Also, in September, we saw some of the capital channels to the infrastructure bond, which is also what led to a slower growth compared to the second. So in the first quarter, we saw investors take advantage of the low prices in January and February, but that slowed down in March. Then in the second quarter, the strong performance came on the back of earnings releases. Most counters released their full year numbers towards the end of March and in April and May. So that is the main driver in the second quarter, and the same carried to that quarter. Also, similarly in turnover, we saw the turnover peak in second quarter for the same reason. Top movers, Safaricom as usual was the top mover, which accounted for 49% of the total turnover for the third quarter, which is generally within range. Though we saw also banks taking up a slightly higher share in the third quarter. There was a lot of optimism following the first half numbers, which were much better than expected. As percentage of market cap, you can see Safaricom is the largest share of market cap, which has so for the last many years. Bank and KCB increased their share, but we saw UBL decrease slightly. Top gainers and top losers, we generally had mid cap and small cap counters, no large caps featured. On the top gainer side, most of it is actually most top gainers and top losers are driven by the retail side of the market. So top losers, we saw some key events there, especially with NBV and Crown Paints. So Nairobi Business Ventures and Crown Paints, that was generally a correction coming from strong uptick in the second quarter, because NBV had a transaction where that the top shareholder became Delta from Dubai at 84% shareholding. And they also announced new acquisitions, basically changing the whole model of the business. So there was a strong uptick in the first and second quarter. So the third quarter decline was more of correction, as well as Crown Paints, which had a rights issue in the first half of the year, which was concluded. So the third quarter slowed down as some sort of correction. So in terms of the fourth quarter, most of the activity in the market will definitely be boosted by banks' quarter three earnings. Is actually very critical because it helps us gauge full year earnings much better. And of course, also Safaricom first half numbers. We also think some of the things that are ongoing or will be very key in the fourth quarter. We expect KCB to finalize its acquisitions in Rwanda and Tanzania. This is a transaction where they acquired the BPR bank in Rwanda, so they'll merge with the bank there, as well as in Tanzania, they acquired the Africa Banking, ABC, Tanzania Africa Banking Corporation. And we think they're also looking to get into DRC, so we wait to see if that will be in the fourth quarter or in the next year. The other bit on fourth quarter, the MTN Uganda IPO is ongoing. So we also think a bit of cash will be channeled to that side. That could affect how much investment will be in the market. There may not be a strong effect compared to the corporate bond. The EABL has a 5-year medium-term note that is ongoing, looking to raise 11 billion at 12.25%. We've seen quite a bit of interest from the institutional investors. So we think this will also affect the amount of capture that's available in the market in October. The other bit is also the reforms in energy sector. The president gave directives with regards to review of PPAs, and there was an immediate response with optimism on the Kenya Power stock. So of course, we are waiting to see, because there's a deadline for December, if those recommendations, or at least a good portion of the recommendations are instituted, then we do expect the power sector to perform much better. And the other one would be the MSCI review on whether KCB will be included back into the index. So in terms of recommendations, as mentioned, the earnings announcement should provide some impetus to the market. The BLMTN will divert some of the funds in October from equities. And we've seen some price dips in the last 2 weeks, which feels more like a correction than a bear run, coming from the peaks that we've seen in the last quarter. So we think they're providing some attractive entry points, especially if you look at the banks, Safaricom as well, Safaricom is at 42, which had peaked at 44.95. Equity Bank has gone to the 40s from peaks of 50s, and we're very optimistic with Equity Bank, especially looking at how well the DRC business is doing. and we're expecting a full year dividend this time, which might be slightly higher than their usual levels, a higher payout. So definitely equity is an entry point. KCB as well, which is in the lower 40s now, coming from 49 shillings, as well as EABL. We know this is the half year when they perform the best. And as compared to the last year, we don't have the very strong containment measures where bars were closed or at least till 7. So we're expecting, and as we expect the restrictions to ease, we think KBL will definitely perform better. Data Zoo are also sort of underpriced, and the fundamental outlook is not concerning. That's Kengen, Centum, and WPP Scan Group. So generally, in terms of sectors, we are positive on telecommunications, power sector, consumer goods, that's BAT and EABL, and select banking stocks, which would be Equity Bank, KCB, and Absa Bank. Thank you.
I'll take you through the fixed income component of the presentation. And really, the backdrop to fixed income investing is primarily driven by what is happening in the economy, and especially government spending and borrowing. And as you can see from that first chart, in terms of how the evolution of government allocation in the last 3 years, we can see that development expenditure has been mostly stable. But if you look at recurrent expenditure, it's been continuously inching upwards. Then you also look at interest and pension. That's also been going up quite significantly. And of course, the allocation to counties has also been going up proportionally, because that's also relative to the size of the budget. So we continue to see this being a key driver for spending. And you can see there in terms of the net domestic financing requirements, that we're still going to continue seeing the government being in the market and looking to be able to tap into resources to finance that deficit. I think Kenya has been fortunate in being able to tap into the robust market locally. And so I think that's something that we expect will continue. And it's something that markets across East Africa, we've seen markets remain very buoyant. We look at Uganda, very robust market, Rwanda. The domestic markets across Africa are increasingly looking to become a lot more stable. I think even Tanzania now, they've lengthened the maturity curve, 25-year bond, very heavily oversubscribed. So the macro situation across most markets across Africa is increasingly looking stable, and especially within East Africa. And Kenya has been at the forefront of that, and we expect that to continue. I think on the tax collection bit, we are at about 70% of GDP, which while comfortable, if you benchmark Kenya against other countries, it means that there is room for the tax collection bit to increase probably towards 20%. So we think that that's going to provide a little bit of support on that front, hoping that the targets set for the Revenue Authority are realistic, just to ensure that at the end of the day, we do actually end up with a good balance between spending and capital raise and the financing bit, as well as the tax collections. So you see here, this really still builds up on the story around the domestic market, and you can see, we don't have too many maturities coming up, and if we imagine the capital build-up, especially in the pension industry, it tells you that this money needs to find a home. Either it needs to get into the equities market or the fixed income market. In the near term, we are seeing a number of primary issues, at least the infrastructure bond that raised quite a substantial pool in the market. And now we are seeing a bit of interest, especially from the corporates. So maybe that's going to provide a bit of competition with the commercial by the government. But really, when you look at this horizon, we are looking at a scenario where interest rates are likely to remain mostly stable, maybe inching upwards slightly. Maybe we could move to the next slide just to have a better look at that. Maybe before that, we look at the turnover. So activity this year has been quite robust. So if you look at bond turnover, for every quarter this year, we've performed better than the previous 2 years. And cumulatively, year to date, we are up almost 50% in activity, and that tells you about the interest investors are having in the fixed income space. Primary issues have continued to attract robust uptake from investors, as you can see from the oversubscriptions on the chart below. We can move to the next slide just to look at the yield curve. Yes, so the yield curve with the one with trackers, that's really the most recent yield curve, and you can see that it's inched up slightly from December, and that's the yield curve just below that one, and just below the one with the markers, and you can actually see it's been a very gradual shift. But of course, something just worth noting, whether that's going to be significant for holders of fixed income, because if you have something significant shifting, then it is likely to have an impact on the portfolio holding. So if you need to mark down the value of your fixed income portfolio, that could happen. But so far, that shift has been very gradual. I think if you look back 10 years, and the graph and the yield curve below, the one in blue, really shows you that we've been at points where interest rates have been substantially lower. Of course, in 2015, we saw the yield curve almost flatten. And so our sense is that the current yield curve would probably maintain at the current levels, maybe inching upwards slightly, depending on a number of issues and depending on how the government, how the macro situation and how the government tax collection bit works out, as well as the spending bit. As you might well know, that we're getting into an election cycle, and that does tend to precipitate a bit of additional spending. If you look at the inflation, the chart at the bottom there, bottom right, we see inflation has been mostly stable over the last 3 years. And in fact, apart from around, maybe late 2017, we've really not had inflation going beyond 8%, and core inflation has been much lower. So if you look at it over the last 10 years, broadly, you can argue that inflation has been under control. In recent months, we've seen commodity prices globally rising, especially fuel, and that does tend to feed into the inflation. So the question is what policymakers' decision could be, with regards to being able to address this likely impact. Of course, we do have the issue about the drought and food situation. And the food situation, in fact, at the moment, while we might be talking about drought, some of the food basket areas, we're actually having very heavy rains. And if they persist significantly, we could have a reduction in terms of the seed maize, which is produced for the next season, and then we could also have a reduced harvest. So which we could feed into inflation, food inflation, into next year. So I think it's something that we're watching quite keenly. But I think at the moment, we think the scenario remains quite mostly under control if you consider all factors considered. Maybe you can go to the next slide. Yeah. So, yeah, looking at the interest rates and private sector credit, again, a story where we've seen interest rates being mostly on a downward trajectory, if you look at it over a longer period. But despite this reduction in interest rate, we've seen private sector credit remain stubbornly low to pick up. And this is really, and of course now we're also looking at the banking sector having very significant NPLs, especially as at December we're looking at close to 14%. That has eased as at June, but this is something that remains of concern. The banking sector are looking to lend to, looking at, for example, risk pricing mechanism, especially for the low segment or slightly riskier segment of the economy. But what bothers us is whether higher interest rates in an economy which might well be having such high NPLs, whether it would mean you would be looking at really raising the risk, the overall risk of their loan portfolio, or whether it will be suitable for customers. So I think there has to be a good balance struck on that end. So this is really the outlook, and the last slide. And this is really my favorite slide, and it almost never changes. Every time you look at it, I mean, these things are still relevant almost as ever. And we really call it the unholy trinity, because it's really about three conflicting policy goals. Firstly, it's about higher spending, and we see it in government trying to invest in infrastructure, trying to focus on the Big Four agenda, and other projects in MTP3. We've seen, especially over the last 1 to 2 years, increased spending to address the COVID-19 situation. So the response around that has necessitated higher spending, and we've also seen significant amount of support around that. And then the upcoming election. And we look at that, the higher spending, but there's still a need to contain debt. So public debt continues to rise over the years. And in fact, now we're talking about the debt ceiling. And when you look at the debt to GDP level, and even if you consider the recent rebasing of the economy, you're still looking at a scenario that warrants concern, especially if we do not address one of the key levers, either raising revenue or reducing spending or moderating the increase of spending. So that remains a key area, and government has maybe, to its great credit, tried to adopt public-private partnerships. And one of the other key issues, especially when you consider the state-owned enterprises, is to try and see how do you manage weakness in some of these enterprises, which at the end of the day end up bringing the guarantees back to government. So if you look at companies like Kenya Power, Kenya Airways, a significant amount of exposure that government ends up in case these entities run into trouble. And and when you look at the higher spending and the need to contain debt, also the citizens are resistant to tax increases, and this remains very, very politically very difficult. What we've seen the government do in recent years is to try and consolidate past gains. And they're quite clever, especially introducing, for example, inflation adjustment, which essentially, instead of announcing increases every year, just have an inflation adjustment, which ensures that, as a government, they're guaranteed of, being able to tap into additional revenue to address the inflation effect. And increasingly as well in recent years, we've seen quite a number of loopholes addressed, especially when you consider multinationals. And so that's also been something that is quite helpful. And then also digital services tax, trying to address tax around the services space. And the concern, I mean, you can see now the issue of fuel, taxes on fuel and electricity, the tariffs in that have become a topical issue in recent weeks. And, we have various committees which ultimately might result to some adjustment downward. But of course, the key risk there is that, if you have lower taxes and, how do you adjust the spending and how do you contain the debt? So you have these different areas sort of working against each other. But hopefully, if they don't get too dislocated, then the fixed income market will probably remain quite attractive for investors.
Before we get to the global markets team, we're going to hear from our executive director for COPFIN, Lorna. Lorna, please, over to you.
Thank you, Edla. And I welcome everybody who's on the call. Thank you for logging in. I'll just briefly go through the overview of the corporate finance market. It's not been a very active one, considering what has been going on in terms of the COVID-19. Generally the performance of the economy and the companies. But we do have a positive outlook on the corporate finance in the coming years, considering because of the subdued activity. It's likely because right now the COVID-19 pandemic, it looks like there's a better understanding to it, then and the economies are opening up, then we are likely to start seeing a bit of more activities, new businesses coming up, a lot of investment in the new businesses, and the existing ones who went through some challenges, economic challenges. So that is likely to drive more activity in the coming year and quarter. So before COVID, we had quite a chunk of transactions for corporate finance. There's a report that was done by the African Private Equity and Venture Capital Association, and this did give 110 out of 194 deals, private equity and venture capital deals conducted in Kenya pre-COVID-19. So this shows the attraction of Kenya for funding and for growth companies. So there's been a lot of attraction in that, especially in the IT, financial sectors, energy sector. Those have been very attractive for funding, either within or from investors coming in from outside. So with the travel restrictions, we saw that the dampening, and currently with the low vaccination number, there's still that underperformance compared to 2020, and we see more companies coming for private fundraisings, with a few public issuances. We've had quite a drought in public issuances or public companies raising funds. But in this quarter, we do see a few of interest. We'll see it in the next coming slides. One of the ways companies would be able to weather the storm would be to merge, but we've seen more of joint ventures, but still we do see still a lot of financial difficulties as a result of supply chain disruptions, the stifled economic activity. We've seen some renewed interest, even as our research team has reported. We've seen a bit of commercial debt and bond activity in the market. There was a recent fundraising by Family Bank, and they were able to raise about 4.4 billion against a target of 3 billion. This gives, indicates a bit of liquidity in the market and an interest. So I think in the coming time, we are likely to see more activity, because this is an indication there could be an appetite for this kind of transactions. Previously, we saw Centum also raising a bond, 3 billion. That was last year. Private equity and the direct foreign investments have dominated the market and have recorded the highest number of deals during the year. As mentioned earlier, we've not had so many public capital market transactions. We've only seen Crown Paints raising about 600 million. And Nation Media, there was an activity on Nation Media, there was a share buyback. So that's the match that has happened in the recent past in the public capital market, and we do hope in the coming year, despite it being an election year, we do hope that there will be some renewed activity in the public capital market. This is just the overall highlight of quarter 3 compared to quarter 2, and we've seen a slight increase in the number of deals, but we do note as mentioned earlier, the interest has been more on the ICT telecoms, the energy sector, and followed by the financial services sector. Next slide. As mentioned earlier, this is just like the overall analysis of the type of transactions, and we can see the lagging of public capital market transactions. We do hope with a few changes, proposed changes with the capital market in their approach, the Capital Market Authority in their approach to the capital markets. We hope to see a bit of more transactions. We've seen the new developments with the Nairobi Securities Exchange, where they've come up with new products, including an unquoted platform and the Ibuka program. So we hope that we'll be able to catalyze a little bit of more activities in the capital market for companies coming into the public capital market. This has been highlighted before. we've not seen much of mergers and acquisitions activities. Have been subdued, but without just a marginal increase of 2 deals. The region's banking sector recorded majority of the M&A deals. For example, Equity Group acquired an additional 7.7% stake in Equity Bank Congo. KCB Group also completed an acquisition of Rwandese lender from Atlas Mara, and INM Group also completed an acquisition of 90% stake of Orient Bank in Uganda. So in the banking sector, we've seen quite a bit of mergers and acquisition. Private equity has also dominated the market with a higher preference among investors. There has not been very many exits because of the subdued market, which was unlikely to yield good returns for the investors. We've also seen a bit of the real estate, the rate market, and commercial bank, with the notable transactions recorded in Q2, which was the Family Bank, and they just opened EABL MTN. We saw a rate coming in, that's Econ rate, even though it was in the other quarter. So we expect to also see that coming up, because there has been a bit of success in the rate market. So we expect to see some bit of activity in the rate market. This is our market outlook and the deals to look out for, especially in the public space. As had been mentioned by Lisa, there's been some activity with the Nairobi Business Venture, which have announced intentions of purchasing. There was some activity in that line. They were acquired by the Delta Automobile. So there's been that activity, and being a listed company, that has influenced the performance of the company. We also expect a rights issue going by the AGM meetings of the two companies, TransCentury and TPS. They've showed intention of coming into the market for a rights issue. So that's also a likely public offer likely to come into the market. Currently, there's an IPO going on for MTN Uganda, who have already received approval to list 20% of its shareholding. So that is something interesting for the East Africa market. And we hope that, considering how it will perform, we hope that could also raise a bit of more interest in the public offers. There is also the ongoing EABL medium-term note. So that also gives an indication of the interest that might be there in the fixed income space, which we've seen currently is the more active capital raising venture has been going on, apart from the private equity space. Thank you. I think there has not been much, so we just look forward to most likely after the elections to have more activity in the the corporate finance space, because basically it's driven more by the economic outlook, and we do see a lot of already a lot of expectation of companies coming to seek for funds into the capital market. So we believe next year, or possibly after the election, we are likely to see a bit of more transactions in the public space. Thank you.
Thank you so much, Lorna. We're gonna move on to the final presentation, which is going to come from Nash from our global markets team. Nash, please.
Good afternoon, everyone. So my name is Nahash Mungai. I'm the Executive Director in charge of global markets here at Standard Investment Bank. Thank you, everyone, for attending our webinar today. So I'll just quickly give you the Q3 global highlights. So I'll make my presentation very short because I really want us to focus on the questions. I've seen a lot of questions in the chat room, and I think a lot of them relate to the Mansa X product, which is really one of our main products in the global markets department. And I really want us to deal with that. So in Q3, we saw a really flat market. And it's very interesting how Q3 was, because the first 2 months of the quarter, we actually saw a much higher market. So we saw about 5% gain in the S&P 500, which is the main market in the US markets. And in September, towards the tail end of Q3, we then saw declines in the market, enough to actually erase the entire gain in Q3. But and to answer a few questions as I still present, it's important to note that the trading model for Mansa X allows us to actually take advantage of those two moves, even if they happen in the same period, and I'll explain that later. We also saw global sovereign bonds little changed in the quarter, mostly because markets were really waiting to see what the Federal Reserve will do. The Federal Reserve is the main central bank of the US, and it's usually very important to see what their policy is, as it really guides the movement of most of the global markets. Commodities were very interesting, especially in September, when we saw commodities like oil jump almost 2%, and that's a significant gain. We're now trading at above $80 a barrel. We expect, and possibly we might see $100 a barrel by the end of Q4. US equities notched up a small positive return in Q3, to be specific, about 0.2%. And this goes back to my original point, where I mentioned that, yes, we saw an uptick of about 5% and then lost the bulk of that in September. Again, this is really because of Federal Reserve policies, and I'll explain that later. Eurozone equities are also flat in Q3. If you look at the FTSE, the German DAX, the French CAC 40, they were all flat in Q3, not much movement there. And again, this is really because of central bank policy and concerns around whether the stimulus in most markets is going to continue or not. Asian equities, this is where we saw the biggest movements, and sadly, these were really negative movements. The biggest reason for this is due to a company called, the biggest reason for this because of Evergrande, and this is a Chinese company that's really in real estate that has struggled in making their payments to their bondholders. And this is significant because the real estate market in China accounts for about 29% of their GDP. So if you have issues in the real estate market, there are real concerns about whether this will affect the financial markets there. So that's where we saw Asian equities drop sharply. If you look at Alibaba dropping over 35%, and the culprit in this case, Evergrande, dropping over 75%, that's quite significant. And of course, there has been concerns around whether this will cause other markets around the world to be affected. Yields were unchanged for the quarter, but it's very important that we discuss yields and the effect of yields on on equities. So the average dividend yield, which means what a company pays as the dividend versus how much you pay for that stock. So that percentage, if you look at the average dividend yield for the US stocks is around 1.3% right now. But the US 10-year treasuries for the first time ticked, okay, at least this year ticked above that yield, because now we have the US 10-year treasury is trading at around 1.6. So what does this mean for markets? It means that capital then flows from the stock markets to a much more higher yielding financial instrument, in this case, the US Treasury yields, which can have a negative impact on US equities. So yes, it looks like they were unchanged, but it's important to note that in August, we had yields as low as 1.09, and this jumped to as high as 1.5 at the end of September. And now, as I speak, we're at around 1.63. That's a number that you should be watching. That's a number we are also watching to determine how we rearrange our portfolio moving forward. Then the number that's really exciting as well for Q3 is a Bloomberg Commodity Index, which gained 5% in September. The biggest mover there was natural gas. You had a heat wave in Europe, so there was a lot of demand for cooling, and this comes mostly from natural gas. Of course, crude joined in that move, gaining about 2% for the quarter. A big part of that move happening in September. And the reason for this is a combination of factors. The first one, you had the Hurricane Ida earlier on, which really created a bottleneck in supply. And then now the demand that then came due to that heat wave towards the end of the quarter. We expect moving forward that commodity prices will continue to gain. And again, moving forward, and I'll explain this in a bit, this is what will determine what the inflation numbers will be, which again will determine how we rebalance our portfolios for investors in Mansa X. So that's a Mansa X 30-month performance update. So the last three bars there represent the performance this year. So in Q1, we gave you a return of 4.19%, 2.61 in Q2, and 3.74 in Q3. So year to date, we are talking about an annualized return of about just about 14% after fees, which is really just under 20% before fees. I saw a question in the group, and I'll keep answering questions as I'm presenting, just to make my presentation relevant to our audience. So our performance is slightly lower compared to last year, at least year to date. And there are certain reasons for this. The most obvious one being a big part of our performance last year was really around the reopening optimism that came towards the tail end of Q2 and the beginning of Q3. If you look at the beginning of Q3, our performance jumped significantly to 6% in one quarter, and that remained relatively high, even to close at 5% for 2020. There was a reason for this. So markets were generally optimistic that economies reopening would mean more revenues for most companies. And of course, again, rising commodity prices and so on, things that we were able to take advantage of, and those opportunities then boosted our returns. The conversation and narrative this year, whereas, yes, we still have the conversations around reopening, that has also been subdued by the conversation around inflationary fears. Just to give you a context, if you look at last year around this time, the US inflation numbers were just under 2%. Actually, to be specific, closer to 1%, about 1.25% inflation rate last year. Right now, we are talking about an inflation rate in the US of 5.3%. That's significant, and that's a significant jump, which means that the conversation around the free money that essentially markets have been taking advantage of through something you call stimulus, which is essentially just a technical term for printing money, means that there's only so much you can use stimulus by reducing interest rates in an environment where inflation is going up. So fears that there might be lower stimulus in the coming months, a term referred to as tapering in our financial markets jargon, means that investors and then more careful around buying stocks. All right. So we then get a more subdued market, less volatility as investors adopt a wait and see attitude as we wait for the Federal Reserve announcements, which we expect to happen in November. So I need to put that into context so that you understand why that performance is a bit different from what you saw in 2020. And it's also important that I emphasize that Mansa X is also designed to not only give above average returns, but also to protect investors from downside risk. So if you look at the performance of most stocks in Q3, and I'll give examples. If you look at a stock like Amazon, dropped 4.5% in that quarter alone. If you look at Facebook, dropped about 2.3% that quarter alone. Our choice of stocks, if you look at what we are holding mostly, all of them were up. All right. If I take a stock like Morgan Stanley, it was up 6.3%. This is in a market where the S&P did not move. All right. That tells you our stock picking is still above average. We hold stocks like NVIDIA. NVIDIA was up almost 4%. Again, in a market where the overall stock market was unmoved and barely moved. CVS Pharmacy, stocks that we hold here and are very unique to the fund, again, up more than 3%. Microsoft, we're very big on Pepsi. And all these stocks, we like to hold them. They give us good dividend yields and they give us dollar dividend yields. And they also give us capital gains. This model, we have proven over and over again, will continuously give above average returns for our investors. We also hold stocks like Safaricom. Again, I saw somebody in the audience ask, we hold Safaricom. Are the events in Ethiopia probably going to weigh down on the returns for Safaricom? Well, that's a very good question. It's something that we have debated here within SIB for a few months now. But we believe that Safaricom has a long way to go. Our revenues should continue to grow. So we expect that any negative impact from the Ethiopia investment, if any at all, will be then compensated by that growth. However, we still feel that Safaricom did not go into Ethiopia alone, and that was clever. So they went in as a consortium with Sumitomo and CDC, which again, even from a government perspective, keeps them sort of protected and the investments protected. So just to answer that question from the audience, no, we still expect that Safaricom will be well supported. One of our top holdings is also gold. I'd say maybe that's one of our biggest disappointments in Q3, relatively unchanged. And as you well know, we've always been one of the biggest proponents of holding gold in our portfolio. But moving forward in Q4, we expect that this will turn around and gold will be one of the best investments that we're holding. We employ a lot of use of derivatives in the fund. A lot of this, I will not go into details, but derivatives essentially allow us to protect investors from downside risks and also help us to take advantage of adverse movements based on the part of the world we're in, emerging markets, actually more frontier markets, meaning that we're able to take advantage of currency movements that might go against the fund. And right now, Mansa X clients also take advantage of the fund that the fact that the fund is mostly invested in dollar-denominated assets, meaning that you might have noticed the shilling depreciated by about 2% in Q3 alone, moving from a low of about 107.7. Right now, we are trading closer to 111. And that alone, due to the dollar assets that we hold, continue to be supportive of the returns for Mansa X. Again, which is one of the reasons why we encourage investors to invest, exactly why we ask investors to invest in a fund like this. That's one of the few reasons we do that. What we expect in Q4, moving forward, you really have to really look at the valuations of companies. We will be very keen on valuations of companies. We are staying away from companies that will have their margins constrained by supply side inflation. So we'll stay away from maybe consumer staple companies, for example, because their margins, they might not be able to move or rather to pass on extra costs to their clients. So, you stay away from companies like Walmart and Unilever, for example, for such reasons. And we will still continue to use the model that we have used this year. in a sense, it might reduce the return for us. We would probably have earned a lot more if we were in a lot more growth stocks earlier, but dividend stocks have allowed us to continue to make a return for our clients in spite of a slowdown in markets. We will continue to use our strategy moving into Q4 because it has served us well. And for this reason, I'll also answer a question I saw in the audience, somebody asking, how do you protect yourself against markets that have, against a high inflation environment? So one of the things, again, is to invest in companies that pay proper dividends, companies where those dividends cannot be affected by higher rising costs. So, for example, utility companies. Just going back to the US, for example, we go into companies like Exelon. We go into companies like Duke Energy, and we also in railway stocks as well. For example, Canadian National Railways has continued to pay us a very good dividend, and they're able to pass on their costs to the clients, meaning that they're immune from inflation. And that's one of the companies that we'll continue looking at. So the implications of Evergrande, of course, that will continue to be something that the markets look at, especially how China reacts to this. It's not yet a failure right now, and we highly doubt that the Chinese government will allow it to be a failure. But of course, the potential for failure is usually bad enough for markets. So yes, we'll be watching that. Yes, there could be implications, and how it affects the Asian markets, and how companies that had invested in Asian markets are then dragged down by the whole debacle. But I don't think that it's one of the things that global markets should be focusing on right now. Global markets, and anyone who's looking at portfolios that are exposed to global financial instruments, should really be focused on inflationary numbers, because inflationary numbers are the ones that will determine what central banks will do, and whatever central banks do is what will determine how the stock markets and commodities will react in Q4. We still think that it will also be very interesting to see how certain currencies behave to shifting market dynamics. So we think and predict that slowdown in US equities might create higher valuation numbers for safe haven currencies. So safe haven currencies, we're talking about the Japanese yen, the Swiss franc, and naturally the dollar. And here at Mansa X, we continue to take long-term positions that should be able to squeeze out a return based on that shifting dynamic in markets. So yeah, so that's what we have there, and of course, that also affects how metals behave. We are very big on metals here. We trade, as I mentioned, we've held gold positions for more than, since we started the fund. We also swing trade metals like silver. And we expect that moving into Q4, we might have more support of these metals, mostly because of the dynamics around lower valuation in equities, and then capital then looking for a safe haven, which these metals have tended to be.
We can move on to the Q&A section now.
So do I just go through the ones I'm seeing in the chat room?
Yes, please.
Okay. So somebody asked me, we were hopeful of the Q3 performance, but the results did not meet our expectations. What could have happened? Well, I hope I've explained that. Markets were relatively subdued in Q3. And to be honest, we are actually very happy about our performance because, as I mentioned, an entire market moves only 0.3%. Our stock pickings on average return 5 to 6%. That tells you that we picked out the right stocks. And in spite of the fact that, yes, some did not perform as well, the fact that the few that we picked out performed still gave us a return that was reasonably okay. A Q3 performance in annualized terms was 14.96. That's an almost 15% performance after fees. That's a 20% performance before fees. I think the portfolio, we cannot actually say that the portfolio, I think it did well. It's 300 basis points lower than last year, yes, but the year is still not over, and I feel that we're on the right track. And as I mentioned earlier, at Mansa X, we look for returns, but we do not take disproportionate risk. It's one thing to give returns. It's another to create risk as you search for those returns that can create another more difficult conversation with our investors. That we are very careful about. I answered the question about Safaricom. Mansa X returns. Somebody asked why we on a downward trend for the last 2 years. I think I should have answered that enough by now. And then someone asked that next year is an election year. How is Mansa X expected to perform? So one of the reasons why we created this fund was exactly because of that. Every election year, we had to come and explain to our investors why their investments were not performing, and it was mostly because of elections. Because we only invested in local assets, and that's exactly where we sat down and created a fund that created exposure to financial instruments outside our borders. So, just to answer your question, no, the performance of Mansa is not affected by elections next year, so you don't have to worry about that. And in fact, it should give you comfort that you're invested in a fund that actually protects you from that. Lucy Mbogo is asking that the performance for this quarter was way below the projections. Kindly shared because there were no lockdowns. So again, as I said, Mansa X will perform above average. That's our main intention, but we still have to work within the markets that exist. All right. So if global markets are behaving a certain way, again, we still have to be aligned to those markets. And it's very difficult for Mansa X to exist outside the markets it participates in. How can we position our portfolio in terms of high inflation? I answered that. So you typically should invest in asset classes that are not aligned to inflation. So high dividend yielding stocks, utility stocks, and these are stocks that we own within the fund. These are some of the questions that we answer on your behalf on a daily basis as we are making investment decisions. What are the projections for the fourth quarter? Well, we expect that with the Federal Reserve coming out clear on whether they're going to taper or not, which is something we expect halfway through November, then the markets will get a trend, and therefore we expect that the fourth quarter should continue to, should give us a robust performance. So just to answer your question, the projections will therefore be not too far from what we've seen this year, but again, we still expect to perform better than what the market is currently offering other investors. What do we expect from the election year? As I mentioned earlier, we are actually immune to the effects of local elections.
So someone wants to know if SIB invest in rights, and what are the prospects as far as those go?
Okay, we are currently not invested in any rights, but we have owned rights in Mansa X before, not necessarily local ones, but we have. So they can be an interesting investment proposition. We were just looking at it recently here and saw that the dividend yield, for example, for the Fahari I-Rate that's listed on the Nairobi Stock Exchange is 7 to 8%. If you ask me, I would rather buy the Fahari I-Rate than buy any property in this town, because that's a much higher yield than you'd earn buying a property in this country and renting it out. So it's still a very good investment if you ask me. The market has not rewarded that yield, but again, those are some of the reasons why sometimes you find assets that are undervalued. I still think that for high right, it trades below the book value, which is very strange.
Next question: what is your take on crypto?
Well, we've always argued here that cryptocurrencies are not a real asset. How do you define an asset? You define an asset by an instrument that gives you future cash flows. All right. So just to be technical here, the value of an asset is really the present value of future cash flows. All right. That's what determines what the price of an asset really is. But cryptocurrencies don't offer any interest rates. They're not backed by any government or whatever. So that means that the value of that product does not have something you call intrinsic value. So the real value of a cryptocurrency is really just what you decide it is, and if you decide that it's that value and someone else is willing to pay for it, then that gives it a value. That's called a greater fool theory in economics, and it essentially refers to tokens that have no real value, but can make money for investors in the short term. So if you're really speculative and you're willing to ride that wave, go for it. But within the fund, our risk management framework wouldn't allow us to invest in something like that.
Okay. Titus would like to know, perhaps I should channel this to the research team. What is your take on the EABL medium-term note?
Yes, maybe I can take that. So when we looked at the note, it does look, so the coupon we're looking at is around 12.25%. It's a senior note, so generally a much, so essentially it's less risk. There are less options, so compared to other recent issues where you have, for example, a floating option or all these options, I think that has not been provided for the East African breweries note. But we suspect the reason is that the advisors gauged the market and they saw significant appetite, and they thought for a credit-worthy, a certain level of credit level for, say, let's say for EABL, and for that pricing, if you look at the premium they've put on top of the 5-year note, because it's a 5-year instrument, they believe that they'll be able to raise the required funding. So of course, in advisory, that's really, you want to strike the right balance of being able to get the right uptake, while at the same time ensuring that the client gets the most affordable form of credit. And I suspect that's the reason they price it that way. And given the recent appetite in the market and liquidity, even though in the near term we're seeing a bit of liquidity tightness, it's possible that they'll get the uptake that they're looking at. For now, I think that's our view.
Thank you, Eric. Perhaps you could also help us to answer what should we expect in our stock and bond market when the CBK turns hawkish?
The question is whether they'll actually start raising interest rates. I think in the near term, when we've listened to the central bank governor about what their sense is about recent market conditions, especially when you think about inflation, their sense is that a lot of this, even if they were to raise interest rates, it will not have an impact because it's really, for example, commodity driven, and so it would not really have an impact in the market. In fact, it could actually worsen the scenario. So we feel reasonably confident that in the short term, we will probably see them maintaining the current stance. So interest rates should remain reasonably moderate. In fact, if you look at if you compare the global markets versus Kenya in terms of just the interest rates, our sense that our interest rates are still quite modest. Whereas when you look at some of the other markets globally, we are looking at multi-year highs in terms of inflation, some 10 years, 15 years. And when you looked at our inflation rate, pretty stable, I would say. And even if we've had a little bit of an increase, it's still a small notch, which I think will not worry the central bank too much, especially if you think about the currency. It's probably nothing to worry about relative to other global economies. So I suspect at the moment we'll probably maintain the current stance. But speaking more importantly to what the impact would be, of course, it means a negative for the market. If that scenario comes. But again, in the market, we are seeing the performance starting to turn around, especially the banking sector. And Lisa did allude to that, confidence about the performance of the economy starting to turn around. And of course, you only raise rates when the economy is really doing well. And so hopefully we start seeing the stocks delivering solid numbers. And then at that point, then it's possible that the market will be able to adopt to high interest rates. But I think at the moment there's still room. And when you look at private sector credit, it's still below 10%, I think around 7%. Still quite low relative to historical levels. And while we might not want to go back to historical levels, it still tells you that that there's still some significant underperformance in the economy. So I think we might be in this environment for a while. Thank you.
Thank you, Eric. So we have a few more questions about Mansa X, which I will channel towards Nash. One is, are we regulated by the CMA? Number two, why do we not provide monthly statements for Mansa X? And thirdly, can we provide a breakdown by percentage of what is invested in each portfolio for Mansa X?
Are we regulated by the CMA? Absolutely. And just to clarify, we are the only ones regulated by the CMA to do specifically what you do. So the ability to invest in online markets is something that is unique to us in terms of licensing. And Mansa X is really a combination of the online money manager license that we received at the tail end of 2018 and the investment banking license that we have from the CMA. So it's a combination of two licenses, which is also unique. And we use that to create a multi-asset strategy fund. Why don't you provide monthly statements? Well, the reason for this is because there is a lot of markets tend to be, because we are a market determined fund. Okay, so our returns are not continuous and smooth, and they do not go up continuously over a specific timeline. They are market determined, meaning that they go up and sometimes they go down. We felt that continuously giving our investors that sort of experience to have to deal with the erratic nature of markets would not be in their best interest. So that's why we do quarterly returns. We feel that that's a much more reasonable period to have sort of amalgamated the returns for that period and be able to then inform our clients at that time how they performed. It's really something that not because we're incapable of it, but it's because it's a much more hygienic way to present our returns to our investors. Can we give a breakdown of our holdings in percentage terms? Well, if we did that, then we'd lose our proprietary advantage. What we do as Mansa X is unique to ourselves. It's something that no one else has done locally. We find that, yes, we can give you maybe the top holdings, and if you are then looking for percentages around that, it's something we can maybe discuss. But we're not very comfortable to give you the actual holdings of our portfolio, because then that means we lose our edge, and that's what this product is all about also. Thank you.
One more question. So are we seeing this as a good time to look at China, or are things too unpredictable there?
No. Things are too unpredictable there. I know there's always that temptation to say a market is under pressure, so maybe there are some valuations there that might be good. That's also true, but I guess, in my opinion, maybe wait it out a bit, because then you don't want a combination of the Evergrande concerns and then the tapering at the same time. Then that would mean that if there's any movement, then China will get the biggest movement first. There are other better ways and easier ways to make money than that.
Right. Deviate a little bit from Mansa X. Someone would like to know, a few people actually would like to know what advice we have for speculators as far as the MTN IPO. Eric, perhaps you could help with that.
Yeah, so the MTN, that's the rights issue. That's the IPO going on in Uganda for the telecommunications company there. And this has been a trend we are seeing across many markets, where regulators now insist on telcos, which form very critical parts of the economy, to list in the domestic market. So MTN is listing in Uganda. From a macro scenario, we like the Ugandan market, especially when you think about the population. There are some restrictive tariffs potentially in that market, but generally, if you look at it, the pricing is looking attractive relative to Safaricom. Of course, they're not operating in the same environment, and they don't have the same type of proprietary sort of products. But our initial sense, well, we're still looking at the detailed information memorandum, is that we think it'll be a good stock. Hopefully it will be quite liquid. It's quite sizable. So we think it's going to be quite liquid and going to attract a lot more investors in that market. So of course, if you're investing in another jurisdiction, one of the other elements to consider is the exchange rate, and then how smooth it will be to get your money out. So it might be easy getting your money in and getting your money out. But Uganda is actually a very attractive market generally. So I think it's something that we're still looking at it, but we feel more positive when you look at the initial numbers. But we need to dig into the numbers a little bit more. But our sense is we feel good about the numbers.
Thanks, Eric. We have an individual who wants to know if we target chamas and whether we can sell the idea to his particular chama, whether that can be arranged. And to answer that, yes, we are willing to talk to groups. If you would like for us to talk to any group that you're a part of, all you need to do is send an email to clientservices@sib.co.ke. We'll reach out, we'll organize everything, and you get whatever information that you need. Back to Mansa X. Nash, someone would like to know, can you lose your investment in Mansa X? Someone else would like to know, what is our progress in automating top-ups and viewing statements? And lastly, can we introduce deposit and withdrawals by M-Pesa?
So, can you lose your investment in in Mansa X? Well, like I said earlier, this is not a guaranteed product. It's a market-determined product. We created a very strict risk management framework that protects our investors' returns. In fact, the fact that we have never had a negative month since we started the fund is really just testament of how effective that system is, because based on the fact that markets can be volatile, we have managed to protect our investors from downside risks. Does that mean that you cannot have a negative month? You could, all right? And it's very important that every time you're talking to anybody who manages your money, it's very important that you have that honest conversation with them, because a lot of fund managers will give the impression that, managing funds is sort of a guaranteed art. It's not. The only thing a fund manager can do, even the very best in the world, is really just to try and give you returns that outperform others, but constantly look out for the downside, which is what we do for you. And that's why we've always protected our investors' capital since we started the fund. What's our progress on automating statements? Our statements are actually automated, the ones that we send out quarterly, unless you mean that you're looking for statements that can be viewed on a real-time basis. As I mentioned that earlier, if we gave you real-time updates on your statements, I guarantee you'll have a very difficult time, because then you'd have to see you'd have to go through what we go through managing your portfolio, which is really just the ups and downs of markets. And the reason you pay us a 5% fee annually is to not have to go through that. So please let us earn our fees by not passing on the stress and anxiety to you as investors. Are we going to create something that allows you to invest through M-Pesa? At the moment, you still could actually through the pay bill number that we provide on our account opening forms. But if you mean to constantly top up through M-Pesa, there is a mobile application that we are at the almost finishing to develop. We're almost done with that development, and that will allow you to top up and withdraw your funds through a mobile application through M-Pesa. And even just on this point, it is on the basis of this application that we're also about to launch another fund that will have actually a lower minimum investment requirement, mostly because it become administratively easier for us to manage those funds using that mobile application. So this is still in development. We are still testing it internally before we roll it out. But to answer your question, yes, this is something that we take very seriously. Thank you.
So, thank you, Nahashon. So, someone would like to know why, if we can make our statements a little simpler. They have given the example of, can we mirror them to what money market funds usually send, where it's broken down.
If that person can reach out to us and we see what they mean exactly, because when we started the fund, we actually had a statement that a lot of clients complained was too complex. So what we have now is actually a much more simplified version of a statement that we started out with. But again, we're always welcome to, very, very open to feedback. It will be interesting to see exactly what they mean. And if they can send an email directly to us, we'd be happy to have that conversation with them. Yeah, thank you.
So we're gonna answer the last few questions that we still hadn't addressed. One of which is, are we aligning our positions with the current global goals of going green?
Well, are we aligning our positions with the current global goals of going green? Yes. In a sense, we do invest in some companies or some ETFs that are aligned to green energy and so on. But the truth of the matter is some of them, the yields are not that attractive. So it's not something that we come out to say that we are doing, or rather, we don't deliberately go out there to try and invest in green aligned companies. There might be value in that, but at the moment, it's not something that we are really focused on. But we have helped, as SIB, just to answer now from an SIB perspective, we were very instrumental in helping Econ raise funds for their green energy bond. In fact, we were one of the main investments banks behind that 5 billion raise. So if companies are looking for assistance with raising green energy, funds for green energy projects, then this is something that we have experience in and we are very happy to help with.
Well, I guess it's more of a comment, but maybe you might share your thoughts on this. It would be great to have something for people with a higher risk appetite. Is that something that we can do? Then lastly, do we invest in government T-bills?
Sorry, Egla, I didn't get the first question. It would be great. Oh, I have seen it. It would be great to have something for people with a higher risk appetite. Yes. So for those with a higher risk appetite, please reach out to us. We still do discretionary fund management within the global markets department. If you remember Nike's initial presentation, that's one of the things that we mentioned that global markets does. So we can create portfolios that are unique to an investor who's looking to squeeze in a bit more beta, which is what we call volatility here. And that can actually augment your returns, but increase your risk. So please reach out to us directly. You can send us an email. Your second question, Egla?
So the last question that
yes.
we will cover in this forum is, do we invest in Kenya T-bonds? And if yes, what is our strategy on which ones to buy and the amount to invest?
Oh, yes, absolutely. Part of our portfolio, if you look at our top holdings, you'll see Kenyan T-bonds are part of it. Yes, obviously, because if you look at the yield, especially on longer dated papers, we have yields close to 13%. And the nature of our fund is that it's very capital efficient, meaning that at any one time, we have a lot of excess cash. Now, this excess cash will typically go into cash and cash equivalent products such as T-bonds. How do we determine how to get into these bonds and when to exit? Well, we have a very strong research department, as I hope you listen to their presentation, and we constantly have guidelines on how the fixed income market is performing and how it has been, and we're able to then make trades based on this. It's important to note that SIB is one of the biggest investment banks in trading fixed income. In fact, I think we're either the second or third in terms of the volumes that we trade. We trade significant volumes in fixed income, and this information that we have trade in this allows us to pass on this advantage to the investors who invest with us. So yes, just to answer your question, yes, that's some of the asset classes that we invest in. Thank you.
All right, thank you very much, Hashon. Thank you also to Eric, Lorna, and Lisa for making the time, and also to everyone who made the time to attend this session. I will now hand it over to Victor Marangu, our head of distribution, to take us home.
Good afternoon, everybody. Mine is to pass a vote of thanks for everybody for making time to avail yourself. It could not have happened without everybody who managed and to log in and taking their time to listen to us. So I want to I really appreciate Egla for facilitating the event, Lisa took us through equities, Lorna, corporate finance, Eric Musawa, director for research as fixed income, and Nahashan Gay, director for global markets, manages X portfolio, for taking us through and giving us these insights. So I welcome everybody, even into the future, as we continue updating the Kenyan investors on what is happening in the markets, both locally and globally, and how we utilize those opportunities to enhance return on their portfolio. So of all those questions that have kept coming, our team is on standby. We have a financial advisory team that will be able to engage. You can go to our website as well and leave your details, and we'll reach out to you and respond to you accordingly. So thank you so much, everyone, and looking forward, probably end of Q4, then we'll have another engagement and see and compare notes and the progress made even in your own finances. Thank you so much, everyone, and have a lovely evening.